Hello friends, this is our 14th lecture and it will be about IAS 36, Impairment of Assets. So, IAS 36 scope. IAS 36 applies to all assets present in the statement of financial position except investment property at fair value. This area is regulated by IAS 40. Inventories. This area is regulated by IAS 2. Financial assets. This area is regulated by IAS 39 and IFRS 9. Deferred tax assets is regulated by IAS 12. Construction contract assets regulated by IAS 11. Assets held for sale, that's IFRS 5. Agricultural assets at fair value, IAS 41. Employee benefits, IAS 19. Insurance contract assets, IFRS number 4. Basically, IAS 36 still applies to the majority of assets, including property, plant and equipment, intangible assets, and investment property carried at cost. Objective of IAS 36. The objective of IAS 36 impairment of assets is to ensure that an entity's assets are not carried at more than their recoverable amount. The recoverable amount refers to the value of benefits expected to be gained or derived from the asset. So, when does impairment occur? There could be several situations. If our carrying amount of the asset is less than the recoverable amount, then there are no any issues and there is no any impairment in such case. But if our carrying amount of the asset is greater than recoverable amount, then impairment occurs. So, the impairment is recorded in the form of a write-down or a write-off. What is write-down? Write-down refers to a partial adjustment of the carrying amount performed when the asset still has some recoverable value left. Write-off refers to a complete removal of the asset from the books, performed when the recoverable amount of the asset is 0. Recoverable amount. IAS 36 states that recoverable amount of an asset is the higher of fair value less costs of disposal and value in use. Fair value less costs of disposal refers to the price for which an asset may be sold in an orderly transaction between market participants, adjusted for any costs necessary to make the sale possible. Fair value is the universal selling or exit price, not specific to the reporting company. Value in use. Value in use is the present value of the future cash flows expected to be derived from an asset. Value in use is computed on the basis of cash flow projections or forecasts. The forecast should cover cash inflows from continuing use of asset, cash outflows necessary to generate these cash flows, net cash flows from disposal of the asset. So, we are going to continue a discussion of value in use, and the cash flow projections should be based on reasonable assumptions. The most recent budgets and forecasts and extrapolation for periods beyond budgeted projections. The projections should cover a maximum period of 5 years, unless a longer period can be justified. The cash flow projects should exclude the impact of any uncommitted future restructuring or expenditures to enhance the asset's performance. According to IAS 36, the discount rate used should be the rate that investors would require if they were to choose an investment that would generate cash flows of amounts, timings, and risk profile equivalents to those expected from the asset. The discount rate should be pre-tax and independent of the entity's capital structure. So, accounting entries. Accounting entry for impairment loss. We should debit our impairment expense and we should credit our asset. If the impairment reverses a previously upward revaluation, the accounting entry is debit revaluation reserve, credit asset. Impairment review. IAS 36 requires an entity to assess any indicators of impairment at the end of each reporting period. If the indicators suggest any impairment only, then must an entity perform a formal impairment test. So only if the indicators of impairment exist, only then must an entity perform impairment test. The recoverable amount of an asset should be compared to its carrying value in order to determine the impairment amount. IAS 36 requires certain assets to be annually tested for impairment regardless of the indicators. These assets include goodwill, intangible assets with indefinite useful life, intangible assets not yet available for use. According to IAS 36, impairments indicators can come from two sources, internal or external. Examples of internal sources are obsolescence of physical damage, changes in usage of an asset, poor economic performance. Examples of external sources: sudden decline in market value, adverse economic, technological, or legal changes, increase in interest rates, reduction in market capitalization. Impairment process. The impairment test involves estimating the asset's recoverable amount. The recoverable amount is the higher of fair value less cost to sell and value in use. Estimation of fair value during impairment process. In accordance with IFRS 13, fair value is a price that would be received to sell an asset or be paid to transfer a liability in an orderly transaction between market participants at the measurement date. Many assets have available fair values. For example, used cars are traded in secondary markets. Other items are difficult to value. For example, buildings or industrial equipment are valued by professional appraisers. Estimation of value in use. Value in use is the present value of future cash flows expected to be derived from the asset. However, not all assets generate independent cash flows, and that is why assets are grouped into cash-generating units. Cash-generating units. In accordance with IAS 36, a cash generating unit is the smallest identifiable group of assets that generates cash inflows largely independent of other assets. Since cash generating units generate independent cash flows, their fair value in use can be estimated. So, let's look at simple illustration. Our entity, Fluffy Kitten, has a large number of assets. These assets include production equipment, plants, delivery vehicles, office furniture, computers. All of these assets are unlikely to generate cash flows. Hence, the value in use of these assets cannot be estimated. If these assets are grouped together with the assets of the sales department, thereby forming a single unit, the value in use of the entire unit can be ascertained. So, Fluffy Kitten has numerous stores. That's our another illustration. The retail manager in each store is allowed to make all decisions in relation to product range, pricing and marketing. However, purchasing and other support services are centralized. Is such store is an independent cash generating unit? In this case, yes. The definition in IAS 36 emphasizes cash flows and not net cash flows. Therefore, the support services should be ignored and each store should be considered an independent cash generating unit. So in this case, the store is a cash generating unit because retail managers are making decisions in relation to product range, pricing and marketing. So they actually control cash inflows. And here we have a lot of different assets. Just to repeat a little bit, and here we have a lot of different assets, and by itself they do not generate cash flows. However, if they are grouped together with sales department's assets, they could be a cash generating unit. So, certain corporate assets contribute to future cash flows of more than one cash generating unit. Therefore, their value needs to be allocated to each cash generating unit before an impairment test is carried out. Similarly, the value of purchased goodwill is allocated to cash generating units that expect to benefit from the acquisition synergies. The impairment test involves estimating the asset's recoverable amount is the high of fair value less cost to sell and value in use. So let's move further. Let's look through an example just to understand some things, because it sounds probably a little bit difficult for understanding. Fluffy Kitten, our entity Fluffy Kitten, divided its assets into cash generating units. Assets of one such cash generating unit, including allocated goodwill, are listed in the next slide. Let's look at them. So we have goodwill of 22 million, or probably $22. That's not quite important in this case. Let's just assume that's $22. Property, plant and equipment, we have carrying amount of $60, fair value less cost to sales $62. Intangible assets carrying amount, as you can see here, $30, and fair value less costs of disposal $15. Trade receivables $20, and fair value the same, and the same for cash, and we have total for our cash generating unit. So we have additional information here. Goodwill. This asset is not subject to any systematic amortization and must therefore be tested for impairment annually. It doesn't have any market value because there is an assumption that we cannot transfer or sell goodwill to any third party. So, and another additional information, we have the fair value of the company's intangible assets has recently been revised downwards. The cash generating unit fair value, less costs of disposal and value in use have been estimated at 125 and 128 million respectively. So let's just assume that here that millions actually. First question we should ask, is there indication of impairment? If yes, we need to perform quantitative testing. If no, there is no any need to test. Goodwill must be tested irrespective of whether impairment indicators actually exist. Next step is to compare carrying amount of cash generating unit with its recoverable amount. So, in order to define our recoverable amount, we need to compare our value in use and our fair value less cost of disposal, and then to compare the recoverable amount with a carrying amount. So let's define our recoverable amount for our fluffy kitten example. Fair value less cost of disposal is 125 million. Let's look at the conditions. Yes, fair value less cost of disposal is 125 million and value in use is 128. So let's look. Yes, that's correct here. Transferred fair value less cost of disposal is $125 million and value in use is $128 million. The recoverable amount is higher of these two, hence it is 128 million. So the recoverable amount in this case equals to value in use, and here it's 128 million. Let's compare now recoverable amount and carrying value. Our carrying value of cash generating unit is $155 million. Let's look at the table. As you can see here is a total of 155. So that is why the carrying amount of cash generating unit is 125 million. Recoverable amount is 128 million. So recoverable amount is less than carrying amount, hence we have an impairment in the amount of $27 million in this case. 155 minus 128. In the case of impairment identified at the cash generating unit level, the write-down must be allocated and spread out among the various assets that belong to it. IAS 36 provides the order in which impairment losses recognized in respect of the cash generating unit should be allocated to its constituent asset. First of all, we need to reduce the carrying amount of goodwill. Secondly, if the goodwill was completely written off, then reduce carrying value of the other assets of cash generating proportionately to their carrying values. However, no single asset should be written down below its recoverable amount. So, we need also to keep in mind, if a subsequent review finds that recoverable amount of cash generating unit has gone up, the entity may increase the value of its assets as reported in the statement of financial position and recognize corresponding credit within profit and loss. IAS 36 doesn't allow reversals of impairment losses on goodwill. So let's finalize our fluffy kitten example. We have a total impairment of 27 million. Let's just check that all figures were correctly transferred. Yes, it seems that everything is correct here. So, as you can see, we have fair value of least cost to sell of least costs of disposal for different type of assets, and when we distribute impairment, we need to be sure that the value of our assets is not less than fair value less costs of disposal or recoverable amount of individual assets. So, for example, if we, for property, plant and equipment, the carrying amount is less than fair value less costs of disposal, right? So we cannot distribute anything to property, plant and equipment here. And trade receivables, as you can see, they have the same value, so we cannot reuse both trade receivables and cash. The only here the only element of financial statements we can use for distribution of impairment is intangible assets, because its current amount is higher than fair value less costs of disposal. But first of all, we need to use goodwill. So we have a total impairment of 27 million and we have goodwill of 22 million. So first of all, we just write off goodwill to 0. So 22 million is taken from 0, and we have another 5 million of impairment loss, and here we decrease intangible assets by 5 million. So our final estimation, our final carrying amount after impairment will be 128 million. That's for our cash generating unit. So that is the end of our lecture number 14. I hope that it was useful. Thank you very much for watching. Bye.